Director Ken Frisco. A couple of things to get out of the way before we begin. If you do have any questions throughout the course of the presentation, you can feel free to use the questions function on your side panel. That will make it very easy for us to take all those questions and save them till the end of the presentation, where we will do a Q&A with Eric. The other thing is we will have a very brief survey that you can fill out at the end of the webinar. It'll pop up as you exit. It really only takes about 30 seconds to fill out, but it gives us a lot of great information on how we can continue to make our webinars better for you. The last item I want to talk about is the handouts function, which is in your side panel. You're able to get a copy of the PowerPoint slides that Eric will be presenting on today, so you can follow along with him as he presents. With that, I'm going to pass it over to Ken and let him introduce our speaker.
Okay, thank you, Justin. Eric is the International Group Credit Manager for KYOCERA Document Solutions and currently manages risk, reporting, and collection for the Western Hemisphere portfolios. He has over 25 years of experience in risk collection, legal and workout, and order-to-cash management. He's also a certified public accountant and a certified global management accountant. His industry experience includes aerospace and military contracting and subcontracting, consumer electronics, construction, wholesale and retail distribution, and business and industrial equipment. His professional interest focuses on the modeling microeconomic impacts of macroeconomic changes on credit performance of customers in developed and emerging markets. Lastly, Eric is also a board member of the Federation of Credit and Financial Professionals. Without further ado, I'd like to turn it over to Eric to start the webinar.
Good afternoon, and thank you for your time this afternoon. Today we're going to be speaking about part of the loan agreement that is called the loan covenant. This will also incorporate the section of the loan agreement known under the heading of default. And we want to talk about the reasons why credit professionals need to know about loan covenants and how they impact your credit assessment. First, we better describe what a loan covenant actually is. A condition or conditions that the borrower must comply with in order to adhere to the terms of the loan agreement. If the borrower does not act in accordance with the covenants, the loan can be considered in default, and the lender has the right to demand payment, and that's usually payment in full. So, I guess the first question that we need to ask is, why do banks add covenants to loan agreements? When you first enter into a loan agreement with a bank, usually these are collateralized agreements, not always, but the bank does a process called underwriting. Underwriting makes sure that all the representations of the borrower are correct and accurate, and they establish a risk profile for that loan. And based upon that profile, they price the loan. So if it's a higher risk borrower, they're going to want a greater yield on their on the funds that they're lending. If it is a lower risk, they're willing to tolerate a lower yield. A covenant is a mechanism for making sure that the borrower maintains that underwritten loan quality, because if the loan quality deteriorates seriously, the borrower does not want to have a mispriced loan in their portfolio. So the primary reason that a banker or other lender wants to put a covenant into a loan agreement is to maintain the loan quality. They also want to make sure that you have adequate cash flow. The borrower has adequate cash flow. Why? Because they want the borrower to be generating at least enough cash flow to pay back the loan. It's meant to preserve the equity. Equity is that cushion you have between the wolf and the door and you. In fact, that's the door. So we want to make sure that the equity is preserved in a loan agreement if we're the creditor. In a borrower with a known weakness in its capital structure, it's used as a measure to improve the weakness. So for example, if this is a revolving line of credit that's going to be used to sell high margin inventory relatively many times a year with a high number of terms, you're going to expect that you're going to be able to have an improving credit profile over time. Strangely enough, most borrowers do not have a de-escalation clause for interest to say if your if your loan collateral situation or if your business credit profile improves, that you get a lower interest rate. But many have a interest rate escalator if it declines. And also, it makes sure that the bank is keeping an updated picture of the borrower's financial performance and condition throughout the life of the loan. Now, I'm going to talk about some common loan covenants. This sounds really easy when you say it's things that the borrower must do. You should see these in just about any competently drafted loan agreement. Hazard insurance and content insurance. If I'm loaning and I want to make sure that hazards are insured against because I don't want to have some competing claim for the assets of the corporation. And content insurance, especially if I'm lending on those contents, that collateral. Borrower is required to keep insurance coverage on the plant and equipment and inventory in order to safeguard against catastrophic loss of collateral. Many banks will also specifically say that the borrower must maintain what's called business interruption insurance, so that like the Polar Tech factory burned down and it took over a year to rebuild it. So they had highly specialized workers. They actually paid them out of their proceeds and their business interruption insurance during the time that the factory was being rebuilt, even though the factory was not producing anything at the time because it had not yet been rebuilt. Key man life insurance. It ensures the life of the indispensable owner or manager without whom the company could not continue. The lender usually gets an assignment or partial assignment of the policy so that the note is paid off by the insurance proceeds. I've known some, in workout situations, some rather aggressive loan workout officers who have joked, I hope they joked, that they would have a better recovery if they simply killed the person who was the key man in the organization. That I hope was a sense of gallows humor, and they were not actually contemplating that means of recovery. Another one you often see, in fact, I don't believe I've ever seen a loan agreement without it, is payment of taxes, fees, and licenses. You don't want, especially tax liens, which can jump ahead of you, being filed on collateral that you're counting on to meet your obligations in the event of a default. So the borrower agrees to keep expenses up to date, as a failure would result in the assets being encumbered by a lien from the government, which would take precedence to the lien from the bank. We're just going to continue a few more of these. In most cases, you need a guarantor, either cross-corporate guarantee from another affiliated or commonly owned company, and oftentimes a guarantee from the principals or officers of the corporation. And that guarantee is worth a piece of paper it's written on unless you have evidence to the contrary. Evidence to the contrary is personal financial information to determine that the guarantee has assets behind it. When I was starting in credit, I remember going to my boss on an account, and he told me that we should have a personal guarantee on some of this credit profile. And I said I already had one from him. There was no problem. That the customer had told me he had no problem with the personal guarantee. He signed them for everyone. My boss was not as enthused as I was, but that's because I didn't understand the gravitas of the situation. The financial information on the borrower and guarantee, and the continuing assessments by the bank by providing regular, quarterly, or annual financial statements. Depends on the risk profile. What you will find is on moderately to good quality risks, the personal financial statements are submitted on an annual basis, and more frequently, I've seen it in workout situations as frequently as monthly for guarantors on really troubled debts. They also establish minimum financial ratios. And for those of you who do underwriting and credit scoring and analysis, these should be very familiar to you. Certain levels like quick current ratios, which are balance sheet ratios, minimum return on assets, return on equity, which are profitability or income statement ratios, minimum equity, minimum working capital, maximum net worth to leverage back to the balance sheet, and financial information, as we said, on the borrower and the guarantor. Also, you have situations where you have cash burn, startup situations, or new construction where the asset that is being used is not yet generating free cash flow. And in those cases, I'm sorry, I changed that a little too quickly. In those cases, you can set up what are called compensating balances. Those are portions of the money you're being lended, portions that the borrower is lending to the enterprise that is restricted, often held in deposit on the bank, or is not dispersed until certain thresholds or certain targets are met. Those are generically called compensating balances. They can be called a lot of different things, but that's the most common name for them in these agreements. Now, there are also, in these loan covenants, besides things that a borrower must do, there are things that a borrower must not do. The first ones are called positive covenants. These are called negative covenants. So no change or management or merger without prior approval. You don't want to lend to one person and then find out that someone else is there. I think Nationwide is running a series of commercials where Buster Posey is going to deliver a baby because he's kind of sort of just like a doctor. What this does is it guarantees the continuing existence of the borrower, and the hope is it impedes the deterioration of financial condition due to a merger with an unknown entity and, more importantly, an unknown credit quality. In many cases, the borrower is prohibited from getting any other loans on not only a second position in the collateral that the first borrower has, but on other assets that are not part of the collateral profile of the lender. And this is to assure the company does not take on excessive debt affecting the quality of the original loan. And if you look back a few slides, to ensure that the borrower has adequate cash flow to pay the loan. No dividends, withdrawals, or a limited dividend. We don't want the borrower taking the loan and then using that to fund dividends to insiders or shareholders, or otherwise withdrawing the money of the company and loaning it to affiliates, et cetera, et cetera. So in situations where the net worth is being eroded by extraction of capital in form of dividends or stockholder withdrawals, lender may find it necessary to restrict the amount of money that can be taken out of the company. In a subchapter S corporation, that's a corporation with less than 40 shareholders that has where there is no taxing of the dividends. The earnings of the corporation are passed through just like they would be with a partnership, or as they are with the sole proprietorship, and become part of the personal tax filing of the shareholder of the corporation. In those subchapter S corporations, it is not uncommon to limit withdrawals to the owner's tax liability. So if your company makes $1 million and the tax due on that $1 million is going to be $300,000, it would be unreasonable to say that you could not take $300,000 out of the company to pay that tax bill. The good news on that is the tax bill is generally less than 100%, so that means that if you're paying taxes, likely you have earnings, so the borrower's position is better than it was at the beginning of that tax period. A few other things a borrower must know. Often loan covenants will restrict or forbid management fees paid to related parties. They would limit them to a certain amount so that you could not use that as a way to drain resources from the borrower. The reason for the restrictions are the same as the restrictions on dividends. Preventing investment in capital equipment, real estate, or other businesses without separate permission. Once again, you're lending, there is a plan to use these loan proceeds. You want to make sure as a lender that that plan is being followed and that they're not going off and doing entirely different things of unknown risk profiles. We also want to prevent sale or divestiture without separate permission. Once again, this is to ensure that the collateral for the loan is preserved. Now, there are other financial covenants that I'm going to go through here. And this slide came about because I reviewed it with the head of underwriting of a local bank with whom I've been acquainted for many years, and with my wife who does a lot of loans as she works in the real estate industry. And these are some things that they told me, I know they don't fit into your slide deck currently, but you probably should mention them. So there are some financial ratios you may not have used in your current credit scoring, and they're included here. And that's your loan to value ratio, your debt service coverage ratio, interest service coverage ratio, borrowing base calculation. This is often in agreements, especially revolving lines of credit, where defined maximum percentage is applied against the accounts, the business's eligible accounts receivable and or inventory, and that determines how much on a line of credit may be drawn. Something that's not in the slide deck that I did want to put out is especially retailers have what are called payouts or payout cycles. So, for example, you may have a retailer who sells a lot during their fourth quarter, which is the Christmas season period. You may have a clean-out period with their bank where they must, let's say they have a $100 million line of credit for their revolving line of credit, but they must have that paid down to under $10 million or under $15 million for a period of 30 to 45 days, maybe from January 1st to March 15th. I'm sorry, January 1st to February 15th, or from January 1st to February 1st. That's to ensure that the money that is being used for the inventory purchasing and the accounts receivable clearing or the credit card clearing is actually being used for those purposes, and that this can present a problem during the clean-out period and prior to the clean-out period for some vendors in getting paid timely. Other ratios that I didn't include otherwise would be death of an obligor or guarantor, exactly what happens. We did touch on that with the key man insurance. Cross-default or cross-collateralization. My wife hit me over the forehead with this one and said, boy, you better mention that. Oftentimes, you have a covenant which says if you go into default on any other loan, this loan is hereby declared in default. So that's called a cross-collateralized loan. Also, you can have conditions of default where other collateral attaches in the event of a default, or additional collateral attaches. And you can have subordination of guarantor debt. That's actually not an uncommon one, and that is, let's say you have a guarantor who has a claim on the company, who's loaned money to the company. In some cases, taken a secured position in the company. An agreement to let the borrower, let the lender step ahead of that other creditor, that guarantor creditor, is often required for the loan to be consummated. And in the credit world, we spend most of our time worrying about something that happens rarely, and that is what could possibly go wrong. Well, you can have willful violations. There are borrowers out there who, either through negligence, carelessness, or deceit, will willfully violate a controllable affirmative or negative covenant. Some things you wouldn't consider controllable, the death of a guarantor, a catastrophic loss. Those may not be controllable, but controllable or affirmative or negative covenants take out excess dividends. Out of trust on a borrowing base, you're supposed to not be more than $50 million, and you're at $75 million. And the collateral to support that simply isn't there. It's not uncommon to see that with car dealerships and financing companies. And then there's usually a cure period, and we'll talk about cures later, that they have to get back into trust. You'll hear that term sometimes. So failure to maintain insurance or pay taxes, failure to provide financial information, and I should have said on a timely basis, and taking on unapproved debt or undisclosed debt. Financial violations can occur when you violate an uncontrollable affirmative or negative covenant. These are usually performance-based, and this is due to poor performance on the part of the borrower. These can include ratio violations. We discussed the ratios earlier, the balance sheet and income statement ratios, borrowing base erosion due to aging if you're lending on receivables and inventory. Once those receivables start to age, we all know that their value in an aggregate basis declines, and certainly most inventory does not improve with age unless you're in the maybe bourbon or wine business. But if your inventory is getting older, there's likely an obsolescence risk there, which means it's worth less than it was at one time. And, just a decrease in profitability, erosion of margins, or actual losses. Cures. Well, a cure is how you fix a covenant violation so that you don't have a condition of default. 3 important words. Now, most good loan agreements, well-negotiated loan agreements, have pre-established cures for some or all of the covenant violations. So it says, if this happens, this is what you can do to fix it so we do not have an event of default. Actions specified that the borrower can take if a situation occurs. Let's say you have poor performance. The shareholders of the corporation may be allowed to make a capital contribution to the business with a certain predetermined formula, which will make up for the perceived lowering of the credit risk profile of the business. So, I'm concerned the equity is eroded, you posted a loss. Well, I'm putting more money into the business as capital to make up for that loss so that the bank or the lender's overall risk profile for this particular piece of their portfolio, this loan, has not materially decreased. Another way to do that is to pay the loan down to a level where the ratio calculation's in compliance. This works best, obviously, on balance sheet ratios. So you can simply prepay a portion of the loan. Usually, in cases like this, any prepayment penalty is waived to the extent that you're paying down the loan to prevent a ratio-based calculation from creating a default situation. Improving asset quality. In some cases, it can be refurbishing certain equipment, putting it back into service, things like that. Compensating balances, we talked about those earlier. And correcting the violation within the cure period. These are things that just need to be fixed by submitting information that the borrower was supposed to have submitted but did not submit, and paying taxes, license fees, other things that should have been paid but were not. Once again, these cures can be negotiated or they can be predetermined. I believe it's always better to predetermine them. Negotiated, you're back against the wall with a default looming over your head like the sword of Damocles. You can negotiate for a waiver, where you say, well, gosh, gee, our times interest earned ratio was poor, and we promised to bring it into compliance by the end of next quarter. There was a specific situation which was unusual, and we could ask you to forgive us for this current period. we can ask for you to modify the covenant so that the loan is compliant. Or we could ask for a waiver of some issues and modifications of others. Now, from the bank's perspective or the lender's perspective, this waiver and this modification acknowledge formally that their perception of the loan, the perception of where that loan is as far as riskiness, the riskiness has increased. And they're going to want something to compensate for that. So generally, oh yes, you can have a waiver, but you have to pay another underwriting fee and a waiver fee, and they can add up, and the bank can simply ask you to, we'll waive these 3 covenants, but we want $25,000 for each covenant that we're waiving for a quarter. Presumably at the end of next quarter, if you don't fix them, they may ask for $30,000 per covenant waiver. And they're doing this because they're perceiving the loan is riskier, it's mispriced. So now this is a way for them to claw back some of that mispriced risk. You can have pre-established, as I said, cure impacts. Now, if it's pre-established, there's generally no penalty or interest rate change if the cures are successful. So if I say I'm going to put capital in the company, you don't really have an aggregate risk change for this particular loan from the perspective of the bank. As such, they don't need more interest to cover this mispriced loan because at that point it's no longer mispriced, and there's just no penalty because they want you to do something to keep that loan within where it should be as far as their matrix of portfolio risk. This is best used with foreseeable covenant violations. Because they're foreseeable, they can be taken into account during the underwriting and pricing of the loan. Okay? If they involve unfixable factors, such as profitability or external actions, such as a customer's bankruptcy, decreasing the borrowing base, you can still have mechanisms that will maintain the loan quality from the perspective of the lender. Now, when you have to go and you negotiate something, generally there's a penalty or interest rate change or both. Why? Often they're willful violations. In many cases, it's something the borrower just can't fix. So the loan's riskiness is going to increase. It will likely impact that loan value, and it will likely impact the loan risk. I may be repeating myself here a few times, but if I'm repeating myself, I'm trying to do that for stress. I'm trying to drive home the points I feel that are important. Now, if a covenant is cured during a covenant violation is cured during what's called the cure period, generally there's no penalty or interest rate change. As I said, it's cured within a specified term, it's cured by alternative action, and it's unlikely that you're going to have your loan transferred from the loan officers you've grown to know and love and build a relationship and play golf with over the years to evil people who live in a basement or sub-basement of a building, and they're called workout officers or special asset group. And these are the people whose job it is to rob the graves and try and recover whatever assets are possible to work against, to deal with. If you've been on a creditors committee, if you've been involved heavily in a bankrupt customer of yours, you are not working with Joe Loan Officer, you're working with their workout or special assets group who is trying their level best to protect the bank's position and to prevent any losses on their part. There can be other consequences if a covenant is not cured. As we said, generally penalty or interest rate charge. Now they can waive it, give you more time to correct the defect. This is only if it can be cured given time. Sometimes the death of a principal, you can't cure that by giving the debtor more time to fix it. The violation is unlikely to recur, with ratio or other financial measures. Once again, we talked about modifications, a material degradation of borrower's financial condition. You've loaned to a guy who has a building and it's on a main highway or a pretty well-traveled street, and the state comes and they build a highway bypass around it and his traffic drops off. You can't really fix that. So a modification may be in order. Once again, we're talking about risk and loan values, and they're very closely linked. From the bank's perspective, they want to be no worse off than when they were when they wrote this loan. And often, if you do not cure covenants, it is transferred to the workout or special assets group. And the loan officers, you're dealing with new people now. And some pretty hard-boiled people at that, if they're any good. And they're just more difficult to work with. Now, we've talked about things that are related directly to a specific loan or instrument, loan document. There can be other impacts throughout your business, and in fact, other loans can be impacted by failure to perform on an unrelated loan by an unrelated lender. The first thing I'll talk about is a financial statement impact. If you're in technical default, then those loans, of which there was a portion due current and a portion due long-term, and that may be a substantial portion due long-term, a substantial percentage of the note, because it's in technical default, you now have to classify that as a current liability. So if you had a 10-year note with $1 million due this year and $9 million due in subsequent periods, you would show $1 million as a current liability and $9 million as a long-term liability. Now, if you defaulted, or I'll just call it a technical default, you did not meet the terms, conditions, you did not cure within the specified period, you must then classify in your financial statements that entire $10 million owing as a current liability. This can certainly wreak havoc with your working capital ratio, and it can certainly wreak havoc with your current ratio. So, as I said, can change financial ratios, can cause other loans to default. You could then, through these changes in reporting, trigger defaults in other loan agreements. And you can have situations where you have this cascade of woe, I guess is the best way to put it, and that can force the borrower to seek protection from their lender or lenders in bankruptcy. In many cases where borrowers do this, it's a strategic filing. They actually can pay their bills as they come due, but they can't meet the terms of these accelerated notes. So they seek protection from bankruptcy, and that affects all the creditors. I apologize, number 2 here, or II here, is cash flow, not cash low, although cash low is maybe a Freudian slip, because low cash flow, I guess, might be a better way of putting it. The bank may freeze other accounts or payroll, may foreclose the use of a revolving line of credit. The borrower may seek to act upon, repossess, or otherwise protect their collateral position. And something I didn't put here that I probably should have put here is that the bank may have, and this is related to A here, the freezing or other accounts, some banks may require a lender to have a lockbox at their bank. So the money from the accounts receivable comes directly to the bank and then is used to reduce the loan balance. You see this a lot on revolving loans, revolving lines of credit. So it reduces the balance, and based on your borrowing base, you can draw it up. Well, if they stop funding you, you can't take any more money out, and your customers keep sending the money to the bank, you can imagine this can create quite a chaos within your organization, because all the money that you're expecting your customers to pay to make payroll and do the other things a business must do is now being held by your bank, And if you think you're going to get that back anytime soon, you're much mistaken. And as I said, once again, transfer to the workout or special assets group, and the value of the long-standing relationships is lost or impaired. What should you do? Well, I guess the best advice I can give you is if you're going to get financial statements for a customer and it says that the customer has loans, get a copy of the loan documents. If they won't give you a copy of the loan documents, at least get a listing of the covenants so that you can check when you get those financial statements from your customer quarterly or annually or semi-annually or whatever your credit department has established as their standard, that you can check yourself to make sure they're still in compliance. Now, GAAP financial reporting says that you have to mention in the notes to the financial statements any violations of covenants. So they should be there, but they may be on page 437 in 8-point type. So I always tell people when you get a financial statement, the first thing you read is the auditor's opinion to make sure it's only 3 paragraphs long. And the second thing you do is you curl up by the fire with your cat and a nice brandy and 400 pages of notes and read them and then look at the numbers. Okay, publicly traded companies. Covenant compliance is shown in the notes. Filed as exhibits to 10Qs and 10Ks. So if you go on to Edgar and you dig around, you can actually pull up those exhibits. And then you can download them and read them at your leisure. For non-publicly traded companies, it may be shown in the notes. If it's a compilation and the accountant isn't following SARS absolutely perfectly, they may omit that. Ask to see the documents or disclosure of the covenants. Ask the debtor. And never, ever, 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 never agree to subordinate your position without a disclosure of these loan terms and conditions, because you're buying a pig in a poke. You don't know what you're getting, what you're subordinating. And that's it for today. So at this point, I think I have saved, oh wow, we ran about 5 minutes fast. So instead of having 15 minutes to answer any questions, it looks like we have 20 minutes, but usually we don't have 20 minutes worth of questions. So this seminar may end a little early. Justin, I'm going to ask you to help me here, see if we have any questions.
All right, great. Thanks, Eric. If you guys do have any questions, you can feel free to put them into the questions function. That'll be in your side panel bar here. We do have a couple questions that came in, Eric. The first one that came in is, should waivers be considered a red flag? And what do you do for your due diligence when you learn about a waiver and or being out of compliance with your loan covenants?
Well, red flag, I'd say it's like the hurricane double red flag with the black box in the middle. Yes, it certainly is a red flag. First thing you do is you call the customer and you get their explanation of what happened. Generally, they're more than happy to tell you exactly what happened and how they're going about to fix it and how you shouldn't worry or lose any sleep over the situation. It'll be fixed momentarily. And then, assuming that you have diligently collected this information in your credit application, call a loan officer and just, say, what's going on? We have a customer here and we want to continue to sell them things and provide them open account credit. Can you share with us what's going on? And here's a copy of the financial disclosure agreement that they were kind enough to sign when they signed up for a new account. And oftentimes you'll get someone to speak with you. This is, if you're a material supplier, sometimes strategically the bank will want to talk to you, even though banks don't like to usually talk to other creditors, if they think that they may have to repossess collateral. Generally, selling it back to the original supplier is their highest yield on recovery of that collateral. So they're not going to want to foreclose you completely. They're going to, if they think they can make a buck off you, if they have to go to auction and get 50 cents on the dollar and they may be able to sell it to you as 80 cents on the at 80 cents on the dollar, they may want to start building a relationship with you. Hope I answered your question.
Great. The next question we have here is, when do you send in consultants or collections agencies to clean up the accounts receivables and set up internal controls?
Can you ask if this, are they talking about within their company or within the borrower's company? I guess.
Oh, that I'm sure the person who asked the question has heard, so she can answer that accordingly, and then I'll pass that along to you. We can move on to another question now.
Okay.
The next question that we have is, what can we do to keep informed on the loan covenants on non-public entities?
What I would do is I would ask you to get the financial statements. And when you're discussing the financial statements, and I always love to do this in writing, I have a few questions, Mr. Controller or Mr. CFO, and you list the questions, and never the first question, but always somewhere in the top third of that is, are you currently in violation of any covenants, or have you during the period of the financial statements had a covenant failure and subsequently cured that failure? And then you get something back in writing, and if he denies it and he lies to you, well, you've been lied to. There's nothing you can do about that. But if he's truthful with you, he said no, and you can trust his no. Once again, you also check the notes. As I said, non-publicly traded companies, your experience may not always be 100% perfect, but if it's a reviewed financial statement or an audited financial statement, you're going to see covenant loan violations. No accounting firm is going to allow someone to omit that because they don't want to have their malpractice insurance cashed in. But for compiled financial statements, I've seen financial statements with no notes at all. So you can't really trust. I would query the customer, preferably to get something in writing from them saying that they did not have any covenant violations, or they didn't have a covenant violation and subsequently cure it. Next.
All right, great. Going back to the question that we had earlier, she was talking about the borrower's company. So again, the question is, for the borrower's company, when do you send in consultants or collections agencies to clean up the accounts receivable and set up internal controls?
Okay, well, if I'm the bank, if I'm sitting in the bank's position, I'm going to do that as soon as I feel that my collateral position, if I feel that I'm going to get less than 100% on that loan, I'm going to walk in there, I'm going to do inventory audits, I'm going to maybe put in someone there to assist the borrower, and that would obviously include things like maximizing on the accounts receivable, clearing out debt inventory, making sure that internal controls were in place. You're going to want to make sure internal controls are in place before you lend a company money. But that doesn't mean that they're going to be maintained. So, you're going to go in there. Often a workout specialist will go to a company. Rarely, sometimes when you have a significant position, I once spent a month and a half working at a large distributor's site, essentially telling their CFO what bills he was going to pay, what bills he wasn't going to pay right now, and helping them clean their act up. But in 3.5 years of doing workouts, that's the only time I was allowed to literally go run another company until we got them back into a situation where they could function by themselves and pay back their debts properly.
All right, great. The next question we have is, what would you say if there was one or two of the most important takeaways from this presentation? What would they be?
Number one and number two are the same. That's because it's very important. You need to know what the status of your customers' loans are. You should have, ideally, those loan agreements, any amendments to those loan agreements. You should know the covenants, and you should know whether they're in compliance or not, and you should be able to look at a financial statement that you're spreading the numbers on, and you say, are any of these financial covenants likely, and that's an important word, likely or probably going to be violated in the next quarter, the next half year, the next 2 years. It doesn't do you a lot of good to find out about a problem after the damage is done. But to be able to look and say, no way these people are going to be able to make this balloon payment or refinance this debt in 2 years. No way these people are going to continue to meet this cash flow or this EBITDA covenant. Because that's when you can do something about it from the perspective as another creditor. You can take actions to secure your position, or even perhaps in some cases the best thing to do is to walk away. I don't mean abandon your position. I'm simply saying gracefully exit the customer with your bad debt reserve intact. I once did that with an account called Trader Horn, for those of you who are from New Jersey. Unfortunately, I got out about 3 years before they filed. Nobody Beats the Wiz, which is another account in New Jersey, I got out 10 months before they filed, which turned out to be just about perfect. One thing I have learned in 27 years of doing this, though, it is impossible to time bankruptcies. It's even harder than trying to time the market. So when you need to get out, make the decision to get out and get out. And give your salespeople as much notice as possible so they can find other ways to make their quota. Next question.
This is Ken. Is there, in your estimation, a time period that the banks give for cures? I mean, does it vary by the bank, or is there a common cure period?
I've seen 10 days. I've seen 15 days. I've seen 30 days. I don't recall ever seeing a loan covenant that had a cure period of greater than 30 days.
Okay.
And once again, I'm presuming in that these are covenants that can be cured.
All right, great. That's the only questions that I'm seeing on my end. So with that, I think we'll wrap the webinar a little bit early today. I'd like to thank everyone for taking the time out to listen to our presentation. I'd also like to thank Eric for taking the time out to present to our group today. Just as a brief reminder, if you guys could fill out the survey that will pop up at the end of the presentation, it helps to give us a lot of great insight in how we can continue to make these webinars better for you. So with that, we're going to shut down the webinar, and I hope everyone enjoys the rest of their day.